over 125 billion barrels of proven crude oil reserves, and 620 trillion cubic feet of natural gas. Abundant resources to bolster energy access and long-term economic growth. Yet, to achieve all of this, we require over $200 billion of financing every year. This is a very substantial gap for investments. Where will this money come from? That is the question. That is the devil in the room. That is why institutions like us, Premier Invest, play an instrumental role in advising clients across the industry, financial and strategic matters. And this evening we'll attempt to unpack how we can put together strategies to help bridge this financing gap in Africa. Currently, Africa receives only about 5% of all global investments with access to funding. My colleague from Standard Bank said there were several sources of funding to Africa. But yet, due to global shifts in renewable energy and other macroeconomic influences, there is a significant decline of capital going to Africa. We saw in the last 2 days, 2 African sovereigns have been downgraded, which means that their cost of borrowing only goes up. To address this financing challenge, after over 30 years in the industry and after having financing over $300 billion of oil and gas transactions, together with a number of colleagues, we've put together an African-owned and an African-managed investment banking firm, Premier Invest, to offer a range of financial advisory services supporting clients across the industry as they seek to invest in small, medium, and large-scale projects, leveraging our very deep expertise across the industry and geographies, and support projects with lots of financing insights. We bring strategic advice to mergers, acquisition, for all kinds of oil and gas transactions. We are the gateway for African players to unlock capital for their projects. We partner with public and private corporates, and we've closed more recently, some of you will know, a large transaction for a national oil company in Central Africa for over $1.2 billion last month. African governments are heavily dependent on oil and gas revenue to meet their socioeconomic obligations. 50% of oil product consumptions in Africa will be fulfilled by importation, as there's no new investments to upgrade either our refineries or to modernize our facilities. The continent lacks funds to finance its oil and gas projects. The continent also needs technology to manage its oil and gas industry. The oil and gas infrastructure in the continent is unable to sustain the industry. Thus, production doesn't run at its peak, whether it's in Central Africa or it's in West Africa. The continent is largely dependent on imported products when it is actually a net crude producer. We have over 600 million people on the continent who live without access to modern energy. Oil majors, however, are making strong commitments to reduce their emissions in line with the Paris Agreement. A lot of them have set up renewable energy desks. IOCs are beginning to invest in sustainable energy in Africa alongside traditional oil and gas investments. Most of the critical capital pools are pulling away from oil and gas. In spite of that fact, Africa is experiencing robust M&A activity across its oil and gas industry, owing largely to new discoveries that are being made in countries. We've spoken about Namibia, we've talked about Liberia, and other places like Angola. According to the Africa Energy Chamber's State of the Energy 2004 Outlook, which most of you have seen, in 2023, investments in Africa reached about $3.2 billion. While this figure falls short of the transactional weakness in previous years, upwards of 2024, we extend to see this trend growing as further commercial success has happened across Southern and West Africa. I'll mention just a few. Namibia. Beyond Namibia, we have Abu Dhabi, which has acquired Galp Energy's 10% interest in Mozambique. Total Energies and Qatar Energies acquisitions also in South Africa. The recent Asala divestment of Carlyle, with Gabon Oil now preempting, that will also need some investment. ADNOC announcing that it's going to acquire Galp's 10% in Mozambique. And ADNOC again acquiring and boosting its investments in LNG in Southern Africa. So Africa cannot afford to keep its oil and gas resources on the ground. And the companies such as us recognize this. And that is why, with the strong dependency on foreign investments, we believe that we need to find solutions that are African solutions. We need to take our own future and our own destiny into our hands. We cannot continue to rely on partners who are here today and not there tomorrow. It's for this reason that we want to work with partners on fair, equitable terms. And there are new solutions coming to the market. I'm pleased to talk to you about the Africa Energy Bank, for which I was the chairman of the working group up till my resignation from Afrexim Bank, to say the Africa Energy Bank is a new independent entity that is being set up between the African Petroleum Producers Organization and the African Exporting Bank. This initiative will help attain long-term energy sufficiency and security for the continent. It's going to be an independent, supranational, Pan-African financial institution, complying with banking regulations, but being a multilateral. Core investors of this are the African governments themselves from the oil-producing countries. There are 18 of them on the continent. National oil companies, the sovereigns, wealth funds, public and private sector investors, and DFIs. The bank will cover energy classes like oil and gas, natural commodities, upstream, midstream, downstream. Just to give you an update, the bank is going to capitalize at $5 billion. Most of you must have seen in the wires last week that the APO Council of Ministers that held approved that the host country will be Nigeria. So congratulations to Nigeria for that. At the moment, we are waiting for any two of the APO members to sign the establishment agreement and the charter of the bank. Once the two countries ratify that agreement, it becomes law, so the bank becomes officially operational. A project team is going to be appointed to put up the structures of the bank, and we expect that the bank will commence its operations in 2025. Now, given the pressures on global capital pools, there is opportunity through this institution for African players to find funding from such institutions. So it is becoming difficult for large oil and gas projects to receive funding from global funding sources, whether they are hedge funds, international banks. The ESG requirements are quite significant and quite stringent. African governments, African sovereign funds, and DFIs need to recognize that they must play a more important role to anchor these investments by partnering with players who want to support the financing of Africa's oil and gas projects, including our partners in the international scene. And as I conclude, I want to leave you on this very strong note of optimism. Shell has entered into a strategic agreement with us at Premier Invest. This agreement was signed in Nassau in Bahamas in June 2024 to originate and co-finance oil and gas transactions in Africa. This agreement aims to drive growth and investment in the oil and gas sector across the continent Through the partnership, Premier Invest and Shell will work together to identify, evaluate potential opportunities in the oil and gas market, and leverage on our respective expertise and resources to fund projects that have the potential to generate significant returns for the investors, as well as create value for the local communities and economies. Ladies and gentlemen, this represents a very significant step towards the commitment to supporting Africa's energy development and elevation from energy poverty by developing the resources in the oil and gas sector. By pulling our resources together and our expertise, we hope to drive new investment, new innovation, and sustainable development in the region.
Just to give the audience a little bit of background, Liberia has two major basins, and they have quite different geologic features. There's the Liberia Basin, which goes over towards Sierra Leone, and then there's the Harper Basin, which goes over to Cote d'Ivoire. Interesting players have showed huge interest in both of these basins. Exxon and Chevron and Anadarko have all historically drilled in the Liberia Basin. If I'm not mistaken, Harper has not been drilled at all. In light of our time, I'm going to ask you the impossible question, and you're going to fire me tomorrow as your advisor, or tonight. If you could only invest in one of the two basins, which one would you invest in, and why? Oh, let's see if I have my job tomorrow.
Thank you for the question. So a part of me is saying the Liberian Basin, and another is saying the Harper Basin. And so I would just advise you to just go for both of them.
Well done, Marilyn. Look, I think that's right. I mean, so the Liberia Basin has had the interest of the majors, and it's more de-risked, whereas Harper has the better opportunity. That's for sure in terms of better quality fiscal terms, because we want people to get in there. Paul and Oliver, if you could speak on behalf of the investors to the Marylands, to the Olivers of the world. You've told me where you want to invest. What are the critical things you want? What makes you actually write the check? You're a check writer. What makes you get your check back out, Paul? And what could Maryland and Liberia and the other frontier countries do to get your checkbook out?
Well, today, banks can't do exploration because it's not a safe investment for our depositors. But there's nothing to say we can't do fast development. And my guess is countries like Namibia will be doing this in the next couple of years. What we look at is the same fundamentals as Oliver does. It's the rocks, it's the G&G down, but then above ground, it's the above ground risk. And as we're banks in a country, we are ultimately regulated by the same government you're taking an investment risk on. So the above ground risk is something we have an acute view and understanding of. We have significant amounts of money in our case to put out to projects. Mozambique LNG is about $500 million we're out there. We put numbers out there for Rovuma LNG and lots of other projects, including Oliver's company and companies like that. We put significant numbers on. What I would generally say, just giving a little bit of numerical jargon, in most of the African countries we're present, the market's banking limit is about $300 million for any single deal. In our jargon, it's called the SOL.
Wait, can I ask you to say that again? For all of you listening, his limit is $300 million.
The market in a country.
The market,
yeah.
Even more serious.
So what that means is, unless you're Nigeria or South Africa, which is near $1 billion, that means all large oil and gas projects need funding from multiple sources. But raising money in country, getting up to that 300 or something like that, is often one of the most important things you can do as an investor, as a borrower, because then you are allowing the country to have skin in the game, for its banks to have skin in the game. And ideally, as country X grows, X could be Namibia tomorrow, but it could be Liberia the year after, things like stock exchange and pension funds get involved. And that's where the real economic growth happens, because the country is recycling the investment, the fiscal take it gets from Oliver and Co. into the country's banks, into the pension funds, and allowing the citizens to gain a meaningful stake in oil and gas. Yes, Qatar, Abu Dhabi, and so on are good examples, but almost certainly Guyana will be the next one.
I'll start with the checkbook, because, of course, as an E&P company, ultimately, we're stewards of other people's money, so it's our shareholders, it's the bank if we're using their money. So ultimately, very similar point to Paul in that we'll deal with the subsurface, we'll take that risk, that's what we do, but we absolutely need stability of contract. So, you go to sign an exploration contract, a PSC, it's early days, everybody's excited, but you haven't found anything, but you're actually signing a, say, plus or minus 25-year contract, right? You're baking in at that point a future that nobody quite can see or can at least get a quantify, if you like. So the stability of contract is there, and I think what is really important within that is there are going to be winners and losers in the countries, right? If, as capital gets harder to access for the sector, which is happening and will happen, when we go to the banks and we go to Paul, we'll know exactly who they want to fund from a country perspective. There's not much we can do about that, except we will choose to be in the countries that we feel will offer that stability. Mm-hmm. Not necessarily the best terms in terms of rewards for us, but the stability above all else, such that we have a bankable project. And we don't control the rules of what's bankable, but we have to work within those. And so that's absolutely critical. I would just say one word is stability.
Stability.